Are you ready to explore the exciting world of living off of your dividend income? In today's video, we're diving deep into the question that many investors ask. How much pounds invested do you need to live off of dividends? If you've ever dreamt of financial independence where your investments generate a steady stream of income to support your lifestyle, then this video is a must watch. Join me as we uncover the secret strategies and calculations behind living off dividends and discover the path to achieving financial freedom through dividend investing. And if you find this video valuable, don't forget to drop a like and let me know in the comment section down below. So firstly, what is the concept of living off of dividends and how does it work? For those of you that don't know, I'll explain briefly. Dividends are effectively stocks you can hold that generate a reward over time for being invested in them. This is called a dividend. This is paid out through profits of the company. So a company might go, okay, how best can we return value to shareholders? We're quite a mature business, so actually it's unlikely that we're going to be able to grow much. So instead, we'll reinvest that profits that we make and pay it out to shareholders in the form of a dividend. A dividend is simply a cash payment to shareholders that hold the shares on the ex-dividend date, which basically means if you hold a dividend stock on the ex-dividend date, you will be eligible for a dividend payment on the dividend payment date. Effectively, a lot of companies in the UK do this, but typically there are less in the US in particular, mainly because some of them are more growth driven, where they would prefer to reinvest those profits back into the growth of the business and therefore reinvest in their own operations, into mergers and acquisitions, etc. So that's a dividend, that's how it works. But the concept of living off of dividends is quite a special thing because it's the idea here that you could do the investments upfront. You could locate, identify, and discover the top 10 or 20 stocks that pay a dividend. Then you've just got to save up and invest enough money, and then eventually those investments will be working for you. They'll be generating you completely passive income through all you have to do is just hold shares of that stock. It's quite an amazing feeling. Could you imagine? You could be on a beach in Southeast Asia or anywhere you'd like. You might be in Australia, for instance, right? And you know that tomorrow you've got a dividend payment of £1,200 just because you hold shares of Rio Tinto, for example. It's a great feeling and therefore quite an admirable goal, and one that a lot of people try to aim for when they're trying to achieve financial independence. So let's explore it a little bit more. So what factors should you consider when determining how much to invest for living off of dividends? Now, there's quite a few factors here, and you need to identify these in advance because otherwise it's going to be very tough to write up yourself a goal for the long term. Ideally here, we're identifying the factors so we can picture what we want, although understand if you're retirement or you want to live off of dividends in, let's say, 20 or 30 years, what you want now is likely not what you want in the future, but just picture what you want now and we can work towards that goal, because at the end of the day, if what you want now is more expensive than what you want in the future, well then, hey, great, you've got extra money and you've got, a better opportunity to spend that time and that money on something else. So the most important thing here is lifestyle. What kind of a lifestyle do you think you'd like to live? Are you passionate about your hobbies? Is it quite a low cost hobby? So you might just be, I like exploring, going for a walk through nature, or I like taking hikes on different mountains in Morocco, for instance. Well, okay, if that's the case, then you might have a few traveling expenses, let's say flights, but if you're only doing that a few times a year, then overall this is probably not that expensive. After you factor in the average payments that you've got to pay in terms of a house, you may have already paid off your mortgage, but let's assume not maybe. If you haven't paid off your mortgage, well, hey, you've got some dividend income to cover that, your bills, typically that's what's important. So understanding both your lifestyle and your expenses here is also key. So just knowing that if you know that you go to the pub or you'll want to have a read of a book and have a pint of beer at 8 o'clock every single day, well, of course, factor that into your price. Depends what pub you're going to. And of course, it's hard to account for what price these goods are going to be 20 or 30 years in the future. That's where inflation is key. So I've got this great website here and it's called World Data, and effectively what it tells us is the inflation rate of the United Kingdom. I mentioned that because I'm a UK channel, and I think this is quite an interesting trend because it says during the observation period from 1960 to 2022, the average inflation rate was 5.2% per year. meaning an item that costs £100 in 1960 costs £2,152 at the beginning of 2023. And it says here that for April 2023, the year-over-year inflation rate was 7.8%, energy was up 10.5%, and food was up 19.1%. So the reason I bring that up is at the moment, inflation is very high, almost abnormally high. And it's difficult to account for how long this may sustain for. We're rising interest rates or pushing interest rates up in order to decrease spending in the economy. But who knows in particular how much this is really going to push down inflation, because it does seem to be quite persistent. It might mean that we need to increase interest rates even higher, or we may have to levy even more taxes on the individual to really stop the discretionary spend that is happening at the risk of the economic growth. The point I factor in here is the Bank of England's target inflation that they go for each year is 2%. I know there are a wide mark off it at the moment, but we need to be quite realistic in our assumptions. So if we're assuming that perhaps inflation's quite high, it's kind of a bit toppy. So let's look at the last 20 years, for example, which I've put in this calculator here. And it says here, at the start year of 2002, the end year of 2022, I understand we're in 2023, but the data's not there, so unfortunately I can't fetch that. It says that the average depreciation is £25 per year. I've done some quick maths on that, and I believe this is about 2.5% per year. So I think we should round this up and say that per year, we're going to expect something like 3% inflation. Worst comes first, we are completely wrong, and it's actually lower than that. Well, fantastic. You've now got more value of your money when you look to live off of dividends. But it is key to keep this in mind, especially as the UK has greatly underperformed the US, as you can see here, the USA being the darker, more reddish line, and the United Kingdom being the greenish, bluish line, has almost doubled that of the USA. So I guess the UK has outperformed the USA in one thing, but that's inflation. So, okay, fair enough. But yeah, so that's critical to know. We need to know the factors for the longer term future. Another good factor is the annual average return of the markets. We want to know what typical return an investment could generate over time. That way we could then identify and be realistic in our long-term assumptions. So if we look at the S&P 500 annual average rate of return for the last 20 years, this is 8.19%. If you don't know what the S&P 500 is, it's basically the 500 biggest companies listed on the American stock markets by market capitalization, which is the size of the business, and that's worked out by the share price multiplied by the number of shares. Therefore, it's worked out pretty much all in the stock market and based on demand for those shares. So the biggest companies like Apple, for instance, are worth like 2 trillion, for instance, and I think that's a good point of reference to make. Now, there are some strategies here before we get into the amount you actually need to live off of dividend income in order to determine how much or maximizing dividend income and achieving financial goals. So before we get into that amount, I think it's key here that we look for high quality dividend stocks. And if you'd like to look at high quality dividend stocks, or invested in the stock market and you're interested in hearing more about stock updates and what I think some high quality investments are, then definitely click that subscribe button down below. But if we go on to one of my favorite websites here called dividenddata.co.uk, this is a fantastic website for UK listed stocks, but there are plenty of alternatives if you are looking at other markets. For simplicity's sake, we're going to use this website because it covers all of the biggest UK stocks. So a few factors we want to look at: the dividend history and the dividend growth. So let's go to the FTSE 250. Let's look at a random company here, such as one with a dividend. Let's go to Tate and Lyle. We can see that this has been cut recently, which is interesting here. We look at the dividend yield history over time. We can see that it's floated between about 3 and about 5%. And on average, it's been about 4% consistently over time. Well, we can see this has decreased in 2022 for whatever reason. And it says here that the annual dividend was cut from 21.8p to 18.5p. So when we jump into the dividend history page, what we really want to see ideally is a company that is seeing a staircase that gets steeper as it goes to the top. They're increasing their dividend growth each and every year, and that's fantastic, because what we want to know is that buying an investment or a share in a stock right now and looking at the trends of the historic last 20 years, we'd like to know that going forward in the future, hopefully we can see a similar outcome. So hopefully we can see a similar level of dividend growth, because that dividend growth is really going to bring in that compounding effect, which matters a lot. Unfortunately, Tate has cut their dividend here, so it has impacted this. So what I'm going to do instead is I'm going to find you another high quality company, and let's look at Halma, for instance, because I know they've got a good dividend. Yes, their dividend yield is on the lower side, so if we did do the calculation, it would mean you need a lot more money in Halma shares than you would, for instance, in a higher dividend yield stock. But their dividend history, is fantastic. You can see how this is a sloping staircase that gets steeper as you get to the top. On average, in the last 10 years, they've grown their dividend on about 6.9% on average each and every single year. That's fantastic. That's what we want to see, and that's a good quality dividend stock. There are obviously a lot more factors to look into, like the financial health and many other factors determining, does the business actually have a profitable future? Are they in an industry of decline? Well, perhaps it's worth avoiding. But for purely dividend sakes, that's where I'd be definitely looking at as a starting point, as I do think that's really helpful for long-term growth, especially if you can see a company like this that is very consistent. They've always grown between 5 or 7%, and even in the early 2000s by 15 to 20%. I want to see consistently growing income over time. That shows a stable business, one that is likely mostly profitable over time and is able to grow their profits consistently in order to grow their dividend. It's likely why the dividend yield is higher, because people are paying a premium for shares of this stock. So how do you calculate the amount of money needed to generate a desired income from dividends? Okay, so we're going to go jump onto our compound interest calculator here. And we're going to say that we have an initial investment of 0 for now. And what we're actually going to have to do here is we're going to have to do some quick maths beforehand. So to work this out, we're going to find a stock. Let's choose one on the FTSE 100 that has a fairly high dividend yield. Let's go for quite a common stock. Let's look at Lloyds Banking Group that has a 5.35% dividend yield. If we, by doing the maths here, and what we want to do here is what is the average annual income that we want to achieve per year? You've now evaluated your lifestyle, you've evaluated your expenses, and this is what you want to have. So let's say, for instance, I want to live off of £20,000 per year. I'm going to type into my calculator 20,000, and I'm going to divide it by 0.0535. So it looks like that, if you can see it on the screen. I'm not sure. It's not focusing, but yeah, there we are. What will happen is this will now tell us that we need £374,000 invested, if it will focus, in order to achieve that financial independence of living off of our dividends. Now this is critical, because now we know that we need to get 374,000 from investing in Lloyds Banking Group stock. We can go to our compound interest calculator, start at 0. We're going to say an interest rate of 5%. Because we're going to deduct the 8%, and we're going to deduct the average annual inflation rate, which is your 3%, on a conservative basis. So overall, we're going to have a net interest rate, which is your total minus the deductions and the fees and whatever, of 5%. We're going to say over a 40-year period, just to really see what the trend is. How much do we have to deposit? Well, let's just say we're putting in £250 a month, and the compound interval is once a year. Don't get confused on that, because if it was monthly, it'd be fantastic, wouldn't it? But you're only getting paid that dividend as an annual dividend yield. Fortunately, this is literally lined up. I couldn't have done this better myself. Now, if you're, let's say, my age and you're 23 years old right now, if you invest £250 per month and you keep investing in stocks and shares, or you invest in just, let's say, an index fund, right? If you were to then transfer that to shares of Lloyds Banking Group, you'd have £370,700. That's almost enough to reach that 20k per year mark. That's fantastic. And that's with that 5% interest rate. So it's likely going to be maybe higher than that. As we've seen the average, it might not be. It's only an average, so it could be a really bad 20-year period. But over a 40-year period, we're probably going to be quite on the mark, and that's why I've kind of gone for that. So that would be a good one. However, this gets quite more ridiculous if we look at different stocks and shares. Now, let's say we're looking at a little bit more growth, something a bit more spicy in the stock, and I'm looking through the FTSE 100 here, and the growth potential realistically isn't that high. So let's say a company like Sage Group. Now, they haven't really grown too much recently, but it's a good example here. They have a dividend yield of 2.11%. Now, let's say, actually, I want to live off of And in total, I want to live off for £40,000. We're going to do 40,000 divided by 0.0211, and I need to achieve an overall amount of 1.9 million, an extraordinarily high figure, and this is why it really varies on what you can invest in and why it's critical to evaluate at front. Overall, I'd be looking at an average dividend yield, and by having a diversified portfolio of different paying dividend stocks, some with maybe higher dividend growth rates than others, and some with higher dividend yields, you can achieve a balance, and then hopefully the average portfolio yield might be more similar to that of the overall FTSE 100, which might be 3.7%, or if you're a little bit more growth orientated, the FTSE 250, which is at 3.32%. But anyway, factoring that in, that's 1.9 million. Now that is a very, very challenging amount to reach, and it will probably take you about 60 years if you were to do £250 per month. Right, it's very challenging, and not many people have got that, and in fact we're only halfway there. So this is what really matters here, and this is investing more every single month. If I double this amount and put £500 in a month, and you're telling me you can't get yourself a better job and you can't be able to save and invest more money, well, if you're investing £500 a month, this will change the game significantly, because now we have a future investment value of 2.2 million, but a 60-year period is unrealistic. So let's go back to the 40-year period, and let's look at this in total. Now, we're not going to be quite there because, as I say, Sage is quite a high amount, but we've got 740,000. With that 740,000, we may identify here that this could be enough to live off of, annual income using the FTSE 250. So if we do 20,000, we're going to divide here by the current FTSE 250 yield of 0.0332, sorry, it's two threes. We need £602,000, okay? £602,000, well, we chuck that into our compound interest calculator. If we deposit £500 a month for 40 years, well, we're going to be well over that, and we could comfortably live off of a dividend income. However, before we continue, we do also need to consider the risks and considerations with relying on dividends as a primary source of income. As mentioned earlier with Tate and Lyle, dividends can be cut, and you need to really identify there a company that is stable, a company that has a durable competitive advantage and moat. This means that a company that might be paying a good dividend now, and it might have had a great track record previously of paying a dividend, could cut their dividend. Shell is a fantastic example for this because they actually did cut their dividend, and I think it was the first time since World War II, and they actually cut their dividend quite substantially, and obviously that was during the oil crisis back in the pandemic time, so there was nothing they could do about it, but this happened. So it just goes to show that not everything is stable and predictable. It's not quite like a bank interest rate where you could just sit there and get your 3 or 2% per year. This is different. This can go up and it can go down. So that's the point. So by diversifying here and by having a wider range of dividend companies and dividend stocks in total, by having, let's say, 20 dividend stocks, you're going to be getting quite a lot of dividends in frequency. Maybe the overall value of each dividend payment is lower, but it becomes a snowball effect where you can continue to compound over time and really make a dent towards that figure. And I think realistically, before you know it, if you really try incredibly hard to achieve this and you can deposit, let's say, £1,000 a month, now you could probably push in your career to get to this stage. I understand it's tough for some of you, but you've just doubled the future investment value by just doing that in deposits. So there's huge potential here, but what matters is starting early, investing at a young age if you can, and if you haven't, understand that the amount you deposit is also an important weighting factor. So if you're in your mid-30s or late 30s, maybe coming into the 40s, then you probably need to deposit more per month. And if you're going, well, I don't know how I can save the money to invest more, it's probably a case of you need to learn or find a way of earning more money, and that might be through setting up a side hustle, your own business, providing a service to someone else that you can charge a higher fee than maybe what you earn in your 9 to 5. It's all critical, and hopefully, eventually, all of us will be on a beach in an undisclosed location on our own private island, living off dividends and drinking pina coladas in the sunshine. Have a fantastic day.